Hi, my name is Ralph Baker. Thank you for joining me today. I'm the author of a book called Shock Exchange: How Inner City Kids from Brooklyn Predicted the Great Recession and the Pain Ahead. So my background is sort of economics, and it's probably the most influential book in the country right now. A bunch of politicians are plagiarizing it. So when I say we should invest in infrastructure, the president-elect Barack Obama repeats it verbatim. He says he got it from FDR, but we both know where it came from. When I say that we should not let China pirate our software, President Trump repeats it verbatim and uses it as a fodder to start a trade war. When I say that we should tax wealthy colleges to tamp down the rising cost of college, the Senate Finance Committee, House Ways and Means Committee repeats it verbatim. When I say that it was the Federal Reserve and the President and the Obama administration that created inequality, the Bank of International Settlements repeats it verbatim. So now it's common knowledge that it came from the Federal Reserve and the Obama administration after printing $20-30 trillion and giving it to their donors or to the investor class like hedge fund managers, private equity firms, and venture capital firms. But everybody thought it was originally came from Piketty, who said it was R and G and elemental P in the alphabets. But now we know that it's from the Federal Reserve and Fed policy. But today I'm here to talk about Valeant Pharmaceuticals. I write a column called Shocking the Street. It's a premium service in conjunction with Seeking Alpha. I basically try to find mispriced stocks and invest in them and bring light to why I think they're mispriced. And Valeant is a former pharma roll-up in that it was acquiring a serial acquirer of drug companies. And what they would do is acquire these companies, cut R&D, hike the prices, and spike, and really drive the earnings and revenue momentum. And a bunch of hedge fund managers that piled into the stock, drove the stock to like $250, $300 per share. And that worked and appeared to easy money, but now the Fed seems like it's sort of unwinding that easy money and unwinding this quantitative easing and hiking rates. So Valeant was exposed in 2015 by lawmakers like Hillary Clinton, Bernie Sanders, and then ultimately President-elect Donald Trump, who wanted to tamp down this price gouging by drug companies. And it's also investigated by Senate subcommittee that was led by Senator Claire McCaskill and Susan Collins, who investigated Valeant and Turing Pharmaceuticals, and Vetrafin, that was run by Martin Skhreli, and tried to come up with ways to tamp down the price gouging. Valeant decided that it vowed to the public and to lawmakers that it would stop price gouging and repair its image, stop acquiring companies, and focus on cash flow management and paring its $32 billion debt load. The only problem was that it wasn't really part of their DNA. Launching new drugs was key to this new strategy, and it wasn't part of Valeant's DNA. The former CEO, Mike Pearson, left, and now the current management team, which has done a pretty decent job, Joe Popper and the CFO, John Herendeen, have hived assets, pared debt, but it really hasn't. I guess the biggest problem with Valeant is how they value these former companies that they acquired at the height of the market. They had about $42 billion in goodwill and intangibles, which represents a premium above the book value they paid for prior deals at the end of 2015. It's like $42 billion. It's now about $32 billion, which is about 26% less than what it was in 2015. However, the quarterly EBITDA has declined by 58%. So the quarterly EBITDA from Q4 2015 to Q4 2017 is 58% less than what it was in Q4 2015. However, the intangible assets has only declined by 26%. If it declined commensurate with the decline in EBITDA, the goodwill and intangibles will be about $17 billion, or about $14 billion less than what it is now, and Valeant only has about $6 billion in equity. That's something that has to be explained. Like, how can the earnings fall so much, but the value of these intangibles that Valeant has on the balance sheet hasn't fallen commiserately? And I think that's the key to why it's probably insolvent, in my opinion. That being said, I'm going to walk through some notes from the article Valeant is Insolvent from Shocking the Street article I wrote a couple weeks ago. Just basically walk through some of these notes as to why I think it's insolvent. And the key is the company that they bought in 2016 called Salix. I think that's probably the biggest overvaluation. It has a carrying value of about $13.4 billion. I think it's maybe at the most worth maybe $2.5 to $3 billion. So I'll walk you through that. The first step is figuring out Valeant's segment revenue and EBITDA. A lot of people haven't done this. I'm probably the only person who's actually done this before. So at the end of Q4, Valeant had about $2.2 billion in revenue, 1.2 from Bausch and Lomb, 177 million from, 1.2 billion from Bausch and Lomb, 177 million from branded RX, 335 million from U.S. Diversified, and 425 million from Salix. So Salix was about 30% of the company's total revenue. And so I estimate it was about 233 million of EBITDA, which is about 30% of the EBITDA. And I interpolated that from a management presentation Valeant gave as part of his Q4 earnings call. And it gave us the EBITDA. So I interpolated the EBITDA from their the presentation and applied it to total EBITDA. And they have about 117 million of what I would call corporate costs. And I just allocated that back based on Salix's share of total EBITDA, which is about 26%. So I'm estimating that it has about 233 million of segment EBITDA prior to allocations. Another rub is that Valeant was in the market to sell Salix in Q4 2016. Market chatter suggested that a company called Takeda was going to buy it for about maybe 10 billion, and then the price was seemingly to drop to 9 billion. Takeda wanted to do more due diligence, then Valeant pulled the deal before it actually happened. And my guess is that if they had sold it for $9 billion, it would trigger insolvency because Valeant's equity base was much less than it is today, and the carrying value is about $13 billion. So if Takeda bought it for $9 billion or $8 billion or $7 billion, it would have triggered insolvency. So Valeant pulled the deal. They thought that, I guess management felt that the market was not conducive for a transaction at that time, and it would generate a low value. But I think the value of Salix has declined since because it now is facing maybe 17% of the revenue. It's facing a loss of exclusivity, and that's Apriso and Uceris. Both treat ulcerative colitis. Apriso is being challenged by Mylan, and Uceris is being challenged by Teva. Their patents are being challenged. So at Q4, Apriso had a revenue of $34 million. So I'll just walk you through my take on the LOE. I had a revenue of $34 million. I assume the same EBITDA margin of 55%, segment EBITDA margin. So I assumed about 70% of the revenue would go away if it lost exclusivity. And that's an assumption that's based on assumption I made for the loss of exclusivity for Teva's Copaxone that was being challenged by Mylan. I assumed about 70% of the revenue would go away. And that's based on 50% loss in price and another 40% loss in market share. So 70% of the revenue went away for Apriso. The revenue would decline from 34 million to 10 million, and I assume maybe 30% of the costs were variable. So all the costs wouldn't go away, but so EBITDA would decline from 19 million, which is a 55% margin, to $2 million, which is a 20% EBITDA margin. So the margin falls from 55% to 20%, and the EBITDA declines from 19 million to 2 million. So it's a loss of 17 million in EBITDA for Apriso. For Uceris, it's the same assumption: 37 million in revenue, about 20 million EBITDA, 55% margin, a loss of 70% of the revenue, and the operating costs would decline from 17 million to 9 million. So the revenue would decline to 11 million, and would have an EBITDA of about $2 million. So the EBITDA margin would decline from 55% to 20%. And combined, that's a loss of EBITDA for both those products of about maybe $35 million. So the EBITDA would decline from 39 million to about $4 to $5 million. It's a loss of 35 million EBITDA. And I think you should price that in since it's facing exclusivity in terms of how to value these products. On a combined basis, at Q4 2017, Salix had 427 million in revenue and about 233 million in EBITDA. After the loss of exclusivity, the EBITDA would decline from 233 million to about 199 million dollars. And then I applied 30 million of corporate allocations to that business because if a buyer bought this company, they would probably have similar allocations, similar corporate overhead. So after allocating another 30 million of corporate overhead, which is 26% of total corporate allocations, the EBITDA would decline to $168 million. So that's going from 233 million now of EBITDA, 30 million of allocations, which makes the total EBITDA $203 million after corporate allocations. After the loss of LOE, it would go from 203 million to about 168 million of quarterly EBITDA for Salix. Then I annualized the EBITDA. Just said, what's Salix's run rate EBITDA? The run rate EBITDA would be about $673 million. That's after corporate allocations. After the loss of LOE for Apriso and Uceris. And if you put maybe 4 to 5 times the EBITDA multiple on that, you get 2.7 billion to 3.4 billion for Salix after the impact of LOE. And that's being kind, because right now Salix is 65% of, Xifaxan, which treats traveler's diarrhea, is 65% of Salix's total revenue. After the loss of LOE, that impacts Apriso and Uceris, Salix will be over 70% of, Xifaxan will be over 70% of Salix's revenue. So a buyer would really be buying one product that's facing a lot of competition from Allergan's Vyberzi and expected competition from Cosmos' Rifamycin, which could be launched in Q1 2019. And that's from an analysis done by an analyst at David Maris from Wells Fargo, who thinks that Rifamycin could be a threat to Xifaxan. So now you have one product, over 70% of total revenue, that's getting strong competition from Vyberzi, and expected more competition from Rifamycin in Q1 in the first half of 2019. And on top of that, Cosmos is suing Valeant to take back Uceris that I just spoke about earlier. They're letting Valeant distribute Uceris in the United States, and they want that product back, and they're suing to take it back in court. So that's another threat to Uceris. And when Valeant bought Salix in 2016, Salix was distributing Rifamycin prior to the acquisition, which was owned by Cosmos. Cosmos took that product back, so now they want Uceris back. So a couple of threats facing Salix that I think would hurt the value. Ultimately, it has a carrying value of $13.4 billion. I think, being kind, you may value it at somewhere between $2.7 to $3.4 billion, which means that it's overvalued by like $10 billion, an impairment of about $10 billion, and Valeant only has an equity base of $6 billion. So I think that needs to be explained. So at a high level, how does the quarterly EBITDA from Q4 EBITDA from 2015 to Q4 2015 to Q4 2017 fall by 58%, and the intangibles only fall by 26%? How does Salix have a carrying value of 13.4 billion when it had trouble selling to Takeda for maybe market chatter was suggesting 9 to 10 billion a year and a half ago, and since then it's facing a loss of exclusivity for 2 of its key products, and it's getting competition from Vyberzi and potentially from Rifamycin. I think that needs to be explained by management. Management wants to talk about earnings and debt pare downs, but the only thing that matters is this $32 billion asset on its balance sheet. If management can't explain it, I think investors should just reward the stock. I think there's a risk that auditors could force it to write the asset down. If they write it down a little bit, it just brings attention to it. It causes investors to question, why are you writing it down 10% or 20%? Why not write it down to what they think is fair value? Or it could cause the rating agencies to question the value of Valeant's balance sheet, and maybe even stop rating the debt. So maybe they could downgrade the debt or start questioning the quality of Valiant's balance sheet. So I think that's one of the key reasons investors should avoid the stock. I think this $13.4 billion asset has not been explained. I've been asking for it to be explained for a couple quarters now. And management wants to get slick and say, well, we think we have enough cash to pay our bills. That's not the point, whether they have cash or not, or whether they're going to go bankrupt tomorrow. The point is, do your liabilities exclude your assets? That's a question I've been asking for a few quarters now. I have never gotten an answer. So I think the risk for Valiant is that management keeps avoiding the issue, and it just brings more attention to it, or the auditors force Valiant to write down this asset, or the rating agencies start to question the value of this $13.4 billion asset for a segment with one product representing over 65% of total revenue, a segment that's receiving there's potential competition from Mylan and Teva, and it's a loss of exclusivity, and now Cosmo is asking to take UCERIS back. So that's my take on Valiant. All of these notes and schedules and presentations are on Shocking the Street, the newsletter that I write. So you can see all these schedules and all the data behind it. So I guess ultimately I think it's insolvent by about anywhere from $4.7 to $4.1 billion. So if you have any questions, you can ask me online, argue with me, tell me where I'm wrong. But I think ultimately, if the auditors or the rating agencies begin to question this balance sheet, I think it could hurt the stock. I think that's why investors should avoid the stock. That's why I think it's insolvent. Thank you for your time.